Hey everybody, this is Randy McMullen with Amstar Mortgage. I get a lot of questions about escrows and how they work. So I wanted to give you a quick overview just to give you a little bit of an idea about how they work for your transaction. I'm going to make a couple of things that you should know to start out front. One is your escrow account should have a 2-month cushion in it. That's allowed so if your taxes go up, the lender doesn't have to pay out of their pocket to pay your additional tax bill. They get a little bit of a cushion that's allowed by the feds. The second thing is the tax bill is based on the status of the property as of January 1st each year. So if you're buying a renovation or new construction, you may get a tax bill that says you're buying a $400,000 property with an $800 tax bill. That's not the tax bill you're going to get. We'll probably have to go to the closing attorney. They'll prepare an estimate based on the sales price of the house and the current tax level of that particular county and city. So let's look at how escrows are calculated. I'm going to use an assumption that we're going to close on March 27th. And your first payment would be due on May 1st, pretty standard. So if you do, and the tax bill is due on October 15th, and most of the taxes in Georgia are due sometime around October 15th, that means you'd make 6 payments. Now, if you're supposed to pay the entire tax bill, that's 12 months. And if you're supposed to have that 2-month cushion, you need to have about 14 months. So if you've paid in 6 payments, you're going to have to put in about 8 months of taxes at closing. That'll give you your 14 months. If you happen to close in July and your payment is not until September, you're only going to make 2 payments. You're going to have to put in 12 months of taxes at closing. Now, you're also going to get a big escrow refund from your current lender because they've been holding that money, getting ready to pay the tax bill. So you will put the money in, but you'll get it back out. If you're purchasing, it's like the same thing, but a little twist on it. You'd still put in the 8 months, so you'd have 14 months here, but because the seller owned the property for January, February, and most of the month of March, they're going to give you back a credit of 3 months of taxes at closing. So if you put in 8 and you get back 3, really you're going to need about 5 months of taxes at closing. And that works almost every month that you close in. For example, if you close 2 months later, you would need, instead of 8, you'd need 10 months. But if you close 2 months later, instead of getting a refund of 3 months, you're going to get a credit from the seller for 5 months, and you're still back netting about 5 months. So that's why we estimate that on most purchase contracts, unless we know it's new construction or a renovation. I hope that helps. If you have some questions, please give us a call. You can reach me at 770-509-7827, or you can call me or actually email me at randy@amstarloans.com. and I'll get back as quickly as I can. Again, thanks a lot for your time. This is Randy McMullen with Amstar Mortgage.